Hey guys, Tim Melvin here, and welcome to just kind of a macro update. We haven't really done one of these in a couple of weeks, at least a video one. So I wanted to kind of chime in. I know some of y'all probably have questions. What's with this biotech stuff? And you're sending this, KKR's economic update stocks to buy based on that. What's going on? Well, look, I told you when we started, we've got the core portfolios, right? And that's based on our beliefs about and knowledge and testing of what works in the market over time for various goals. So we've given you four core portfolios based on those four core beliefs, right? Value, momentum, trend, and credit, right? If we get all those right, we make a lot of money over time, okay? And whether it's income, total return, or aggressive growth that you want, there's a mix and match of those core four portfolios that should help you increase the probabilities of reaching your goals in the time frame in which you're trying to reach them. That's the core of the flagship report. However, we test and examine a lot of material and data and studies, and we're constantly looking at new ideas, discussing new strategies, testing new theories. Most of this stuff ends up in the garbage can, because it's rehashes, or it's just not very good, or it's derivative of our four core, I'll call them pillars of investing. um, but every once in a while we find something like we found with the biotech piece that Verdad Associates did, Dan Rasmussen and his team. Biotech is the most promising area of the market, right? And biotech has grown up so much. I can remember doing a presentation at an annual event for Shearson Lehman back in 1989 on Amgen and their new product EPO and all the possibilities of that and the bright biotech future. And I keep hearing Disney's Bright Beautiful World, the Carousel of Progress song playing in my brain, but which, by the way, I love that ride. Um, as we look at what biotech has accomplished, we've done a lot, right? Cancer treatments have changed dramatically. The life expectancy for certain forms of cancer is much longer. Some of them have really been erased as a serious fatality event. Um, we're curing a lot of diseases. We're making progress on some of the tough ones, like Alzheimer's and some others. And add AI into this, and the future is getting brighter faster for biotech. Now, the problem is when you look at these smaller biotechs, if you don't have that MD or PhD, or better yet, both behind your name, it's really tough to sort through and figure out who are the winners with capable of spectacular gains, and who's going to zero out my cash over time. Now, Verdad came up with a good formula, and we read their research, we did some testing, we made some phone calls, we checked it out. This works. Okay. I'm not saying it's going to give you all winners, but it increases your probability, right? So by using insider activity, smart money ownership, these are the institutional investors that have teams that have the MDs and the PhDs and the chemical biology degrees, and they know all this stuff. Then when we take this, the insider buying and the smart money buying, the biotech experts with proven track records, when we find those stocks that have multiple of these smart, successful insider institutions that also then show some insider buying, the probabilities are starting to tip in our favor. And then we want to favor those that are spending money on research and trials and are moving through the process, right? And so our valuation market cap is low relative to the amount of cash being spent on trials and things like that. If we can line up all three, we can check off some serious boxes. The first two give us a big probability jump. Adding the third takes that further still. So we've tested this. We like it. We have enormous respect for Dan Rasmussen and the team at Verdad. So we'd be crazy not to steal his very best ideas. So we'll add this to the list of stuff we've stolen from Dan, because he's given us a lot of great ideas over the years. So we bring them to you. This is, if you've got a speculative bent, you want to make some bets on biotech, this is the way to do it. No rumors, no my friend's cousin's friend, nephew said that this might, or I overheard somebody at the doctor's office talking about. None of that. This is the really smart money is buying it. The insiders are buying it, and they're spending their cash on trials and R&D, so they've got some promising stuff going on. If we can combine that, we can spread this across some small bets. Don't make big bets with these, right? To pick one of these and say, oh boy, this is really going, and we're going to put a third of our money in that. Okay, that's no. If one of these companies cures cancer, they make Alzheimer's breakthroughs. A very small bet is going to pay off with massive profits, and maybe one of them will work on pronunciation while speaking quickly, and I can take some of that one. But anyway, let's jump on to what's going on in the world. Okay, when we look at the macro picture of the world right now, when it comes to stocks, the important thing to know is the trend is up, right? All the news, all the angst, everything comes right down to that filter. The trend is up. The geopolitics, everything else have been uh, subsumed by the fact that there's a massive amount of liquidity floating around in the world. Now, my son-in-law Garrett Baldwin does a lot of work on this. I think his Substack is called The Money Printer, or Me and the Money Printer. He does some really cool work. You might want to check it out. But we're not aware that liquidity is the prime driver in the short to intermediate term. Druckenmiller said it years ago. Marty Zweig said it even further back. We started following Zweig's liquidity work in his Fed model all the way back in the 1980s when his book, Winning on Wall Street, I think it was called, something like that. It's still available. And it was fabulous. Liquidity drives what's going on in the market. Don't fight the Fed, that sort of thing. And right now, when we look at the amount of cash in the banking system, it's a lot. We look at credit, not just demand, but loan volumes. Loan volumes are up. And in commercial and industrial, the business lending section, they're up quite a bit. And you've got a lot of money coming out of the banking system as loans to non-depository financial institutions. That's loans to mortgage brokers, private credit, consumer credit companies. And that money is then filtered out into the economy in the form of credit. So plenty of credit, plenty of cash. The Fed is kind of doing ghost quantitative easing because they've stopped shrinking the balance sheet. It was up this week, I think, 9 billion or something like that, as they've gone back to reinvesting coupons and not letting stuff run off. That's material because it does inject cash into the economy. So you've got a flood of liquidity propping up the market. Oh, and that fantastic earnings quarter that we just had did not hurt even a little bit. I mean, bank earnings were up over 22%. The Mag 7, the big tech companies, they were expected to show like a 32% increase, in year-over-year profits. It was 82. So they exceeded by just a little bit. Most companies the average companies in the index, S&P 500, were looking for an 11% increase. They got a 17. So earnings are up. They're better than expected. Add in a lot of liquidity. There's a lot of money still pushing stocks up and to the right. We are benefiting from that rather dramatically in the small cap momentum portfolio. Lots of great stuff happening in that portfolio right now. We've got stocks up 40, 50, 60% just over the last couple of months. We expect that to continue as long as the trend remains favorable. In the deep value section, we're starting to see some really positive results. I mean, we've got very low valuations. We've got some stocks in there that are going to profit from some serious global trends like energy, like a private credit recovery, like global food shortages. So we're really bullish on the deep value side of the portfolio. But then when we come to real estate, very quietly, our real estate stocks are absolutely killing it over the last quarter. I'm just kind of coming in here to look for the numbers. REITs, by the way, REITs have just they're trying to go into a downtrend last week. They're holding it above the major trend lines, but concerns about interest rates were kind of weighing on REITs, but not really in our portfolio so much. Apple, hospitality up 40%. Park Hotels up 40. MDV was up 23% on the takeover over the last quarter. Cousins Properties up 25%. Just solid total returns coming out of our REIT portfolio, because those numbers don't include the dividends, and our average yield is north of 6%, and we've got some dividend growth going on in there. So our average stock, even with a new, much tougher definition of NAV, we got much more conservative in the definitions we were using. We have such a great margin of safety because our average REIT is trading at about 90% of the very conservative net asset value. In the case of a deal, as in the case of Modiv, we're seeing premiums to net asset value. So, and then we've got just solid dividends, solid financials. And some of these in great financial trade are trading as low as 60% of net asset value. So again, from a long-term perspective, we remain really, really bullish on the REIT portfolio. The portfolio I'm most bullish on, and if you're 50 plus, this absolutely, unless you're so far behind, you've got to get hyper aggressive, in which case you're going to be down there and you're going to own the small cap momentum and the small cap deep value, and maybe sprinkle in a little bit of biotech. But if you're not there and you're looking to grow at a modest rate, maybe cake income, the alternative income portfolio is a must own in here. This is asset backed cash flows to a very large degree. We've got real estate, we've got energy infrastructure, we've got mortgage portfolios, both commercial and residential. We've tiptoed into private credit with two of the best, most conservative firms in the business, two of the largest, Main Street Capital and Ares Management, 11, 12% dividends backed by portfolios of loans that are performing much better than the headlines would have you believe. We talked about that when we bought those, and we remain super bullish on the top tier of private credit. And this portfolio is sitting there, and depending how you time your purchases, it's like between 10 and quarter, 10 and a half in income, much of it paid monthly coming off of that portfolio, and the vast majority of it backed by real assets and real cash flows. Many of the cash flows have the ability to go up if inflation should go up. So that portfolio, we look at that and go, if you're looking for a solid long-term total return that's out of the headlines, has lower volatility, you can reinvest the coupons inside an IRA as a total return mechanism. Half that and half REITs is a spectacular way to go on this. If lower volatility, long-term market beating total returns with most of it paid in cash that can't be taken back by market movements, that 50-50 mix is just genius in my not always humble opinion. When we look at the income portfolio, knowing that we're going to be in higher for longer environments in all likelihood, because it's not just energy, right? You had the economy starting to show that turn from the tailwinds that are out there, and you've got reshoring of industries. You've got AI productivity increases starting to show up. Productivity is moving up sharply. You've got data center construction, which, I know we're seeing a lot of noise and news about that. It's one that we have to figure out. Cut back on data centers. China gets ahead. That is a long-term geopolitical problem I don't think we want to live with. I think that, the water and electricity usage, I think that we can work that out with the corporations involved. So that still remains a big tailwind. Then you've got all the tax provisions in the big, beautiful bill that encourage companies to spend money to build factories, to hire workers. So that is a massive tailwind. Looking longer out, we need a couple million new homes at the low end of the marketplace. We're starting to see some signs that people are becoming aware that they can't solve this with financial shenanigans and 80-year mortgages and mortgage security buybacks and all the other stuff that's been talked about. You got to build more houses. So as they come to that, that's a job creation event. So there's all sorts of reasons for the economy to do better. The biggest risks really are well, let's get back to the risk in a minute, because let's frame this around the income. That's higher for longer, which means you're able to continually invest cash with higher yields. You're able to reinvest at higher yields for the long term. Now, at some point, remember, 20% of revenue, federal revenues, are going to interest, and that's about 16% of the actual budget. There's the gap between the budget, borrowed money. at some point they've got to get a handle on interest rates. And when that does, the valuation of our income assets is going to pop dramatically higher. We've got a great period in here to use higher for longer to accumulate positions, reinvest coupons, and get ourselves in a really good position. Now we're going to go deeper into the income portfolio and kind of go through each investment. That's this week's focus piece. And that will be out Monday at some point in the day. But we're super bullish on, and that's me, the cats, the dogs, everybody around here, the whole staff, super bullish on the income portfolio and the income REIT mix for more conservative, total return oriented investors. Dynamite. And it should deliver exactly what you're looking for over time, especially if you make volatility your very best friend and not your worst nightmare. So the biggest risks to all of this, right, are policy, right? Stupid policy can trump liquidity. We've kind of seen that with the last several administrations, making just all sorts of attempts to derail what is a pretty decent economy. So that if we have something that we're going to worry about, that's it. It will show up in credit trend and generally momentum before this becomes a problem. Eventually it creates value opportunities, so we don't lose any sleep over it. We just look at how it frames the opportunity differently and manages our reaction to what's going on. So that's kind of where we are, guys. I mean, macro, there's stuff to worry about, right? Credit spreads are down at levels that look a lot like 2007 or 1999. Just remember, they stayed up there for a while, a couple years before everything went boom, especially in the 1990s. It's something to worry about, and it doesn't mean there's going to be a fire tomorrow, right? But it does mean that the kindling on the forest floor is really dry, and then you put that with valuation, the stuff on the forest floor is dry, and the smaller bushes, well, they're drying out too. So there's lots of kindling and tinder for a big fire if we have a lightning strike. So that's a concern. We're aware of it. We've suggested hedging several times as we've gone through this, using various different assets and asset classes to establish hedges. We're not quite ready to do that again, but we might be soon. So that's kind of where we are, guys. Small cap momentum, cruising along, doing what it's supposed to do. Small cap deep value, lagging behind as you would expect in this type of general market melt up. But there's some extreme opportunities in that portfolio for very solid long-term gains. And remember, momentum's working in a shorter term time frame than the deep value. We are super excited about what's going on in the small deep value portfolio. So, ladies and gentlemen, that is what I have for you this week from the macro outlook. Keep an eye if you've got that speculative. I'm going to take some of this money and I'm going to get super aggressive. I'm going to play for the home run. Let's play for the home run with probability on our side and undated. Right? It's not an options. This doesn't have to happen by a week from Friday. It can happen as we go down the road. So we're going to keep tracking that. And we've got the list of the cross-owned stocks by the bright money, the smart money, the guys with the MHD and the PhDs and all those. And when we see insiders jump on the bandwagon, we're going to let you know about it. Maybe we can make some money here that adds to our overall returns. My promise to you, and I told you this from the start, when I see stuff that I think can make you money, I'm going to tell you about it. Now, some of it's going to be a one-off. It'll be like, hey, look at this. This is what KKR said. Here's some stock ideas around that. Some of it's going to be, we should keep a track on this. Our four cores are not going to change. But we're going to see some other stuff. And when I see it, I'm going to bring it to you. 98% of the stuff that we read, test, discuss, investigate ends up in the garbage can. It's either derivative or it doesn't work. That's going to increase, right? As AI gets more efficient, a lot of these opportunities that everybody talks about, they're going to go away. We are pretty sure that value and trend, fundamental momentum are not going anywhere. Credit's always going to matter. If we can get these right, we're going to be able to prosper regardless of how AI may or may not change the market. So anyway, guys, thank you for being a part of the adventure. If you have any questions or anything, be sure to drop us a line. We usually get back to you within about 24 hours. So anyway, I'll do my best to keep this entertaining, adventurous, and profitable. Thanks for being a part. See you soon.